let's go ahead, let's start off. Alright, I'm sorry for the little bit of delay. Alright, today we're going to be having a look at some indicators. What I wanted to do was, we've done a session earlier on the practical use of indicators, on how indicators are lagging and what should be the best way to either use indicators or not use them for that matter. We'll be concentrating on the Bollinger Bands today, but first let me just talk a little bit about the indicators. I have seen traders, a lot of traders now, come in over here and put in a lot of indicators on the charts. Right? Most traders now, it's not their fault, because whenever you talk about a course or you purchase a book or anybody talks about trading, everybody talks about indicators. Well, indicators can be used, should be used also. I have never undermined the importance of an indicator, but then they should be used correctly for the simple reason that all the indicators are lagging. And just as an example, let me just take, before we start off, do you remember in the last session, when we went over the last session, we went over plotting trend lines and the Fibonacci ratios correctly. We were having a look at this situation, and we said that price was over here, that price, if it breaks this trend line, it is expected to move. I just kept this chart to show all of you, for those of you who had attended the previous session, that price indeed did break that trend line, retested it for that matter. If I can just zoom it inside a little bit, this was the most important point. Price breaks the trend line and retests it. There was a very strong confirmation, and then price indeed did move down. Alright, let's get back to indicators. What I want to do over here is I want to plot a couple of indicators. Now, to remove all of this, I just kept this to show it to you. And let's take this Canadian dollar on the 4-hour itself. And let me start off with the moving averages. Now, moving averages, a lot of traders tend to use moving averages, and it is a pretty decent indicator to be used. Let's take a standard combination. A lot of traders use a crossover of an indicator. Let's use exponential for that matter. Either simple is the best actually, but let's use the exponential. Let's use a figure like a 50 EMA 1, and we will take another moving average of, let's say, 13 EMA. This seems to be a common combination with a lot of traders tend to use. You have a 13 and a 15 EMA going on. So the point is, whenever price or when your indicator, this slower moving, the faster moving indicator crosses the slower moving, or the smaller crosses the larger one, that is the signal to buy or sell. Now, if you look at this, it certainly is quite nice. I mean, if I just trade on this and if I sell on this crossover, that's a nice move. And if I buy on this crossover, it's also a nice move. And again, if I sell on this crossover, again it's a nice move. So you can catch it. But this is on a longer term time basis one, and the price action is a little smooth over here. The trend is pretty much defined. The Canadian dollar on a larger term time frame has a pretty well defined trend. But let me point out a couple of discrepancies over here. Now, if you remember right over here, maybe I shouldn't have removed those trend lines, but if we had used the trend lines, if you remember, we got in somewhere on this retest of the trend line somewhere over here, right? So we would have, if you're using the trend lines, if you're going short or if you're using price action, you would have gotten much earlier. When you're using in, you get in over here. So in effect, what you're doing is you are losing this much part of the move. In this price wise is really not much, but sometimes it does matter to quite a bit. And even if you take it over here, let's say that I can see a kind of a divergence over here, right? I can see price making low and lower lows. Let me zoom this inside, and this is what I'm talking about. This is your low and your lower low. Just give me a moment. I just want to demonstrate the ineffectiveness and the effectiveness of indicators. So you have a low and a lower low. The stochastics over here are going higher. So if this was a divergence, I would have probably, if I wanted to take a long, I would have probably taken a long somewhere over here on the break of this support resistance. You know that we've been through this. Support resistance levels are very, very important. I see a next level over here which was support, which subsequently turned into resistance. So you can see this was support which turned into resistance, and when price breaks that, it brings in a lot of volatility. So we would have got into a trade somewhere over here. Whereas if you're using the moving average, you would have got into the trade over here. So what you're actually doing is you're missing this part of the move. Now on a longer term time frame, it doesn't matter too much because once the trends are defined. But if you're trading on a smaller term time frame, especially 15 minutes or 5 minutes, these discrepancies make a lot of difference, and you get into a move when more than half of the move is over. And I call it, you're the sucker who's left holding the bag, because most of the people have taken up their profits, and let's talk about long. They've taken the profits, and they're ready to sell when you get into the market. Now this is the disadvantage of an indicator. You must use it properly. So we'll be going over the moving averages also. A lot of people tend to use the MACD, the RSI, the CCI, the stochastics, and each and every indicator they can possibly lay their hands upon, put it on the charts, and try to make some sense out of it. Believe me, price action is the best. Now if you look at my charts, let me just show this to you. This is as clean as it gets. I usually have just one stochastic here just to determine divergence, because that's a part of my trading strategy. I use the divergence quite a bit, and for me the stochastic is the best way to identify a divergence. That we'll be going over this in a subsequent session also regarding the stochastic. Price action gives you more than enough clues, and you really don't need indicators. But yes, you can use indicators to supplement your analysis, to complement your analysis. Never use it as just as a leading confirmation of price. All right. Practical points. One, indicators are all lagging. Believe me, if you're going to using the indicators to get into a trade as a leading factor, you're headed for trouble. It's just as simple as that. One of the practical points that I can tell you about this is never ever use an indicator to define your trading parameters. Excuse me, please. Which simply means that if you're going to take a trade based on an indicator, say you're going to enter on your analysis based on some indicator settings, or you're going to exit on that, you're going to get into trouble. You're going to be very late. Let's say if you take that same moving average concept, and if you say that I'm going to be entering a trade only, let's take this. Let's put this down on a smaller term time frame just to demonstrate it a little. Let's take it to the 5-minute chart. I normally don't trade a 5-minute chart, but this is just as an example. Let me just look at it as a 5-minute chart. Now the Canadian dollar has been trending quite a bit. So when price is trending, the moving averages are really effective. But when price is not trending, when price is range bound, this is an example of when price is range bound. Your moving average is just whipsaw over each other, giving you false signals. Right now, again, we'll be going over this, but practical applications. If you are going to be basing your trading parameters, say I'm going to be entering long on the crossover of an indicator. Let's just zoom this. Right? I'm thinking of taking a long somewhere over here. So where do I take the long? This is where my crossover comes in, at this particular bar. And I would probably enter at the close of that bar. Let's be practical about it. Close of this bar has closed somewhere over here, so I would probably be taking an entry over here. By the time I take an entry, price has moved up and it's ready to move down again. So if you're going to be basing your trading on an indicator, enter or exit on a crossover, stochastic line crossover, a MACD line crossover, a moving average crossover, it's not going to work. Your entry parameters, your trading parameters should always be decided by price action. Let's take this particular example over here. When I say price action, a lot of people get confused over what exactly is price action. When I say price action, I mean two very simple things over here. Trend lines and support resistance levels. So if I'm looking at this, if I plot one particular trend line, now we learned how to plot a trend line. just prima facie, this looks to be the best possible trend line over here. So if I am entering on the break of a trend line somewhere, I would probably enter the price somewhere over here. This was the first break of the trend line. I need to confirm it with something. Now, is this a strong level of support and resistance? If I look at this somewhere over here, I can see that. Let me remove this a little and let me plot one zone over here. Now if I plot this particular zone over here, you can see that this was an area of resistance which subsequently turned into support over here, which again turned into support over here. Now these levels are, I call them magnets. Price are attracted to these and price reacts around these levels very, very strongly. So if I use a combination of price action of a break of a trend line and a break of a zone of a support resistance, I would have probably taken a trade entry somewhere over here, which would have been in line with the moving average, but it would have been a stronger confirmation. So a practical point is, do not use your indicators only, primarily to take an entry or decide on the exit of a trade. Try to collaborate it with an indicator. Use price action along with an indicator. So these are the practical points. Now let's get down to the Bollinger Bands. Now Bollinger Bands is one of the most effective indicators, I would call it. Now this indicator is specifically used a lot by option traders because it kind of gives you a time. There's a time factor involved in your Bollinger Bands. Now Forex, the market does not really have volumes. We cannot determine the volume of a Forex market. Now in your trading platform, like in my MetaTrader trading platform, we do have the volume indicator. So if I put on the volume indicator, you can see the volume bars. But that is the volume which is actually just going through your broker. Now I'm trading with Alpari UK. If I put on the volume indicator over here, the volume that I can see is the volume which is being traded through Alpari UK by itself. It's not a reflection of the global market. It's very difficult to put an estimate to the volume of the global market. So in Forex, volumes really don't count too much, but for volumes, as a replacement for volumes, we look at volatility more, and the Bollinger Bands are an excellent indicator to look or to determine the volatility or the volumes. Now Bollinger Bands comprise of this one central moving average. The standard settings are 20. You have a central moving average of 20, and you have two bands with a standard deviation of 2 above and below, which forms the band. So the central one is the moving average and you have a band above and below. Now the advantage with this is that they expand and contract with price action. So in a way they are leading, because when price moves, obviously indicators are all lagging. When price moves, so do the Bollinger Bands, obviously. But then it makes a difference over here because it gives you some indications about price movement. There are some practical that we should be looking at Bollinger Bands. Let's go over some simple facts about Bollinger Bands. One of the first things that we should look at Bollinger Bands is the squeeze of the Bollinger Bands. Now this is what the option traders look at, because when the Bollinger Bands have expanded, let me see if I can find a squeeze, proper squeeze, a real squeeze. Let's take it on a smaller time frame and see if you can find a squeeze. Okay, this looks like an example. Let me take this. When I'm talking about a squeeze, I'm talking about when the bands come together. Now this is one situation, if you can see over here, that the bands, the upper band has expanded, moved down, the lower band has also moved down, and these bands are coming together. When the bands start contracting, I'm sorry, Susanna, period 14.4. I didn't quite get that. The Bollinger Bands has a setting of the period 20. It's a standard setting of 20. I generally don't tweak my indicators because as it is they are lagging, and don't really try and play around too much and keep it on the standard settings. That's about it. Yes, the RSI over here is with a setting of 14, which again is a standard setting, and we'll come down to the RSI, because the reason why I'm using the RSI over here is I have seen that the best complementary indicator to the Bollinger Bands is the RSI. You can also use a MACD along with it. You can maybe use a stochastic along with it, but the RSI it's quite complementary to the Bollinger Bands. All right. Okay. So we are talking about the squeeze over here. Now, when the Bollinger Bands tend to contract, when they come together, it indicates that there is going to be a strong move. So your squeezing of the bands, we can call it contraction of the bands, give an indication of the movement, that there is expected to be a move. Now, of course, it doesn't give you the direction. This is where we tend to use the RSI mode to find out in which direction price is going to go. But in general, a squeeze. So this is what option traders do, because for the simple reason that options involves the element of time. So an option trader needs to know what is the best time to get into the trade so that he can catch the volatility. So when the bands are squeezing together, that is one of the places when you should consider taking a trade. On the other hand, if you look at it alternatively, when your bands are expanded, when there is the maximum difference or maximum distance between the bands, this is the place where I would call there is a maximum distance between the bands. Now this is an indication that price is expected to go either in a consolidation or it may turn into a reversal, which means that when the bands have expanded out, that the move, the trend is coming to an end. And if you look at this right now, we did have an uptrend over here. We're looking at a smaller term time frame. The bands expanded. When there was a maximum distance between the bands, the trend tended to reverse. Now most of the times when the bands expand, price tends to go into a consolidation. So an expansion of the bands when they are at the maximum distance is when you should consider getting out of a trade. When you are in a trade and you've taken a trend and you have ridden a trend, if you can call it, when the bands have expanded and the distance becomes too much and you can see it comparatively, that would be the time to take some profits out of a trade, because the trend might either reverse or it might get into a consolidation. So the most important part of the Bollinger Bands is your contraction and expansion. This is a very, I would call it a leading indicator, because it gives you a good indication of expected price movements. Once again, it's never a confirmation. You need something else, a complementary, a price action to determine all of this. Alright, so that's the first thing that we're looking at. The second point is, of course, the slope of the bands. Now, the central piece of the band, or the central band, is the moving average. Now, simple concept of the moving average, of course, is, let me get back to the moving averages, that a moving average is best used to determine a trend. So if a moving average is sloping towards the downside, as here in this case, is considered to be a downtrend. If it's sloping towards the upside over here, this is an upside, it's considered to be an uptrend. So a moving average determines, visually you can look at the moving average and see whether it's in a slope or not. So since the moving average is central band of your Bollinger Bands, the slope of the Bollinger Bands visually give you the idea of a trend. So on a downtrend you will have your bands going downwards, and an uptrend you will have them going upwards. So it is just one way of determining trend, complementing the moving average. Now the other thing about Bollinger Bands is you can use the Bollinger Bands, the opposite sides of the Bollinger Bands, to set your profit targets. Now if we were looking at this, let's say that I was long and price tends to reverse over here. If I would have gone short, then one of the first places that I would have kept my target, my trade target, would be the opposite side of the band. So here, of course, the bands have expanded, they have moved. When we would have taken the trade, the band would have been slightly lower again. When price starts moving, the bands come up to meet the bands. But the tendency of price, or the tendency of the band to come and meet the price, is very strong. So it's like reverting back to the mean. Price is reverting back to the mean, and your Bollinger Bands give a good indication. So you can use the opposite sides of the Bollinger Bands to determine your trade targets. So that's point number 3. It's a very important point. On the other hand, you cannot say that when price reaches the opposite end of the band, it will reverse. It usually does not. most of the times in a strong trend, when price is in a consolidation or price is range bound, it will tend to bounce between the levels of the bands. But in a trend, price tends to what we call as walk the bands. In a strong trend, price will, in this downtrend, as you can see, it will walk the lower band. And then central moving average, that is a moving average 20, acts as a strong resistance. So when you are looking at a downtrend, the simplest way of looking at it is when you have the Bollinger Bands sloping downwards. The best place to re-enter a trade, or if you've missed out on a trade, is to wait for price to come back in resistance at the mid slope, at the mid band, the moving average. If it finds resistance over here, you can be assured that price is still continuing towards the downside and you can catch the trend. Remember, price tends to walk the bands. This price will not or does not usually bounce off the band except when it's range bound. So you will have price walking the bands, and so long as it remains below, in case of a downtrend, this moving average and a considerable distance below the moving average, you know that the trend is very strong. So it's a good indicator of an ongoing trend. Now, as a trader, when I am taking a trade or when I am in a trade, obviously I need to know that should I hold on to the trade? Will the trade go further? Will it reverse? Should I take some profits? Now, this is where your Bollinger Bands become very, very important, and they can show you visually whether the trend is existing or it's not existing, whether you should remain in the trade. So it helps you in your trade management. Let's get back to the practical points of it, with something which I have always said, that all these things that we use, the Bollinger Bands, any indicators, even levels of support resistance, they are all the tools that we have which help us manage our trades effectively. Your success or failure as a trader completely depends on how you manage the trades, on what your money management and how you're going to manage the trade. And if you use the correct methods, if you use the correct tools to manage trades, you have an edge over others. You cannot use the Bollinger Bands just like that, or you just cannot use a stochastic for a situation which does not really demand it, because this is what 80% of the traders are doing, which is why they lose money. So you must understand the effectiveness of an indicator, the characteristics of an indicator, what is the situation that you should use an indicator, and which will give you an edge in your trade management. Right, so a Bollinger Band will give you a good indication of a trend, and if your middle band acts as a resistance or support, as the case may be, then the trend is continuing. So you can manage your trades, you can ride the trend. And in this case that you have gone with the trend down over here, you have probably gone out of the trade when you have price close above the central band, the moving 20 average. If I have a close of the price, maybe this was a little here and there, maybe yes, maybe no. At this particular stage over here, when you have a strong close of the band above, you know it's time to get out of the trade. So this is where it helps you. Now, but even before, you can catch your reversals on Bollinger Bands, because Bollinger Bands have got one particular characteristic which is quite effective. Of course, like in trading, nothing works 100% of the time, but there's one of the characteristics of the Bollinger Bands which can determine a reversal. So you have, or you can determine when price is expected to reverse by a simple strategy of the Bollinger Band, which says that when price is in a trend, let's take this particular trend, and you have price walking the bands. In a strong trend, you will have price closing outside the bands. As you can see over here, you have price closing outside the band. Price goes outside bands. Generally, as I said, these bands, they expand and contract with price, so they tend to fit into the price. The standard setting of 22 envelopes almost 80% of the price action, so it's kinds of fits into the price. So this is where the Bollinger Bands are leading, because I would call it wraps itself around the price. But you have, in a strong trend, you have price will close outside the bands, and when you have price closing outside the band, it does not mean a reversal. It actually means a strong trend. And when does it include, or when does it say that it's going to reverse? When you have a particular characteristic, when you have one bar, let's say an uptrend, you have the bar closing outside the band. Let's zoom this a little more. Well, I'm talking about these two bars. When you have one bar closing outside the band and the next bar which closes inside the band. Now this characteristic by itself, this two bar pattern on a Bollinger Band, is a very strong indication of a reversal of trend. So anytime if you're writing a trend and you see it comes together when your bands have expanded, and when your bands have expanded and you have one bar which closes above and the second bar which closes inside, so the opposite bar, you know it's that price is going to reverse or is going to go into a consolidation. Similarly, let's have a look at this one. On a downtrend, we were looking at this. When would we have indicated or estimated that there's going to be a change of trend? You have this particular band closing just about outside, it's a down closing bar, and you have the next bar which closes inside. You do have a false alarm over here. This is a false alarm. It does happen usually where you have price closing outside and then closing inside and still continues to the downside. Well, isn't it a fact that nothing ever works 100%? But then if I was in a trade and if I had come across a situation here, particularly here, I would have probably either got out of the trade or taken off my profits. It didn't matter. Now, I really wouldn't mind if price moved a little more and I would have lost out some part of the trade, so long as I got some good profits out of the trade. So these are strong indications. Now again, let's come down to this, right? What did we say? That we have an indication of a reversal. One is, you know when a trend is about to start. So you have price, your bands have started contracting. So let's assume that I would have entered the trade somewhere over here when these bands have contracted. Compared to the bands previously, they are coming together, so I know that there is going to be a move. And something tells me, we'll come back to this, that it's going to be towards the downside. So I enter a trade. And price walks the band, close outside the band, good trend, pull back. It does not close above the mid average. Good, nice trade. I continue with the trade. Over here, I would have thought maybe it's getting into a reversal. Should I get out of the trade or should I wait for a confirmation? Now, what is the confirmation that we are looking for? I'm looking at it practically, that what do you do when you trade? Right? We want to use the indicator in an effective way. How do we trade it? So this is what we look at a trade, your trade management. Now, this is where your RSI comes into picture. Let me go over one particular characteristic of the RSI which determines that whether your trend is going to continue or it's going to change. Right? If you look at this RSI, I am not looking, once again, we do not use the RSI as the standard oversold, overbought. I'm not really concerned whether it's above 70 and it's overbought or it's below 30 and it's oversold and I reverse it. No, I'm seeking to complement along. Let's take this particular trade that I have taken a trade somewhere over here. Let's remove this. Right? I have taken a trade, let's say based on something that I have entered the trade on the break of this one. This is where I enter the trade. Let's say I keep a stop. You can again use your Bollinger Bands or you can use the high. I've kept my stop over here. Expected target, wherever price goes down, we can use the Bollinger Bands. Since it's walking the bands, we want to ride the trend. Now look at the RSI. Now if you look at the RSI over here, what told me that on this contraction of the bands, price is going to make a move. Is it going to go up or is it going to go down? Now if you look at the RSI, let's just look at the levels of the RSI. Let's look at the peaks and the valleys of the RSI. This was the highest high. I'm talking about the peaks and valleys. Then you have the RSI moving down here. Then you have the RSI moving down here. Let me plot a line just to show you. Right, this was the peak. Then you had the RSI moving down to this particular peak. And then you had it moving down here. Then you had it moving down over here. So it implies, this tells you that the peaks of your RSI are going down. We're in a situation here when the bands have contracted. there's going to be a move. Is it going to be towards the upside? Is it going to be towards the downside? I look at the RSI levels and I see that this particular time over here, my RSI has not gone above this particular one. So which tells me that the momentum is still towards the downside. So I will take a short, because it gives me an indication of the momentum. Once again, nothing works 100% of the time. There are times when even I've got caught out. I think it's going to go down. The RSI is here showing nice downward momentum, and for some reason price moves the other way around. Happens. But then most of the times, I would say, and 80% of the time, you get a good confirmation of the momentums. So you have an idea of the direction. Your momentum is towards the downside. You have an idea when price is going to make a volatile move, when it's not in a consolidation. As a trader, isn't that what you need? You know when it's going to make a move, and you know in what direction it's going to make a move. That gives you the edge. And that's how we use the indicators to the best of our advantage. Now let's get into the trade management. Let's take this particular situation over here. Now I've just chosen this at random, right? I just took this as an example. It was chosen at random. I don't think I traded this particular move. I don't even remember this. It's just on the charts. But this is the effectiveness of your Bollinger Bands and coupled with the RSI. At this stage, I would say that the Bollinger Bands may probably, when you're trading the hard right edge of the chart, right, you are somewhere here. You have one strong bar to the downside and you have the next bar closing here. What does it tell you? Is price ready to move up? Once again, let's have a look at the RSI. What was the last peak of the RSI? This was, right? This was the peak of the RSI. Now, if price is going to go up, what the RSI will do, and the RSI is excellent at things like this to determine whether this is going to be, the breakout is going to be a true or false breakout. If price is going to go up, your RSI will break above this horizontal level, above the previous peak. So let me take a confirmation from the RSI before getting out of the trade. Yes, it's showing a possible reversal. So I might take some profits. I might shift my stops down to my break even, maybe even slightly more, lock in some more profits. I don't know what's going to happen. Nothing ever happens. What happens? Price moves down. Price keeps down. You're still in the trade, but look at the RSI. Your RSI is still below. When did your RSI? Now, what I'm going to do is I'm going to be shifting the RSI to this peak. Right, let's zoom this a little inside just to understand what we are doing over here. Right? What we had was, to concentrate on this one, we had the RSI peak over here. Price still moved down, it did not reverse. RSI made a lower peak. I will shift it down further. Now what happens is, at this particular stage, you have a strong bar closing inside the band and you have the RSI moving above the line. Get out of the trade. That's my indication. Okay, I've had a good run, price is reversing, let's get out of the trade. Alright, this is how we use the RSI in complement along with the Bollinger Bands. Now I think I went over a pretty decent example on how do you really use the Bollinger Bands to effectively trade. My idea has always been to use the indicators practically. See, the knowledge that you will get out of a book or from the internet about the Bollinger Bands is available everywhere. I will not be giving you something different if I do the same thing. Right? We are not in a college over here, folks. We are not in school that you come here to learn something and give an exam. What you're doing over here is you want to learn something which will help you trade. And I think the way that we've put this across today, how we managed to trade based on the concepts of the Bollinger Bands, using it with the RSI, managing a trade, is an excellent example of how to use the indicator practically. Alright, I think that's about it, folks. I think I covered what I wanted to cover, the characteristics of the Bollinger Bands, and use them effectively to take a trade, to use or to do that trade. Absolutely, Edward. This advantage of Bollinger Bands with the RSI, especially with the RSI, is that it works across all time frames. Keep the standard settings. The only thing is, I would probably, if you're using it on a higher term time frames, reduce the settings on your RSI. You might go in for a 9-period RSI, because what we want, remember why I'm saying this, we want more peaks and valleys on the RSI so that we can determine the momentum. The RSI is an excellent momentum indicator. It gives you a good sense of a breakout which is false or true. A 14-period on daily time frame will give you slightly lesser amounts of peaks or valleys. A smaller term time frame, or a smaller setting will give you a larger number of ups and downs in the RSI, which is what we are looking for. I don't think we have the time right now, Susanna, but I'm sure you got the concept about this, right? And coming back to your question, Edward, is price action is fractal in nature. What works on a 1-minute time frame will work on the daily time frame, and there are no two ways about it. It's just a question of how you can. The only thing is, on the daily time frame, you may not get so many contractions of your bands. You might probably get it once a month or maybe once in 3 months if you look at the time scale. On a 5-minute you might get it more. That's the only difference, but the concepts work just as well. Alright, folks, if you have any questions about this, just let me know. And of course, just wanted to, oh yes, absolutely, it works on everything. Just wanted to share something with you. I have finalized my London workshop. I'll be conducting my workshop in London on July, this 1 month from now. This is what it is. Let me just put this down over here. Right. Anybody, if you're from London, if you're interested, please, it would be nice. Not yet, Susan. I've got too many things over here. I'm going in on the 1st or 2nd of July. 2nd of July I'll be there, and then I'm staying put in London. I'll be there for a long time. Alright, so anybody who's interested, and we have a webinar. What I'll do is I'll send across the link for the webinar to everybody. You can attend the webinar, of course. There's no harm in attending the webinar, where we'll be going over some practical things like what we did over here today. I would like to see you on the webinar. If you are from UK, somewhere close by Europe, if you're interested in attending the Forex workshop, please feel free. Let me know. You have any questions, please get back to me. I'm always available about anything. This is my email. Let me know. Alright, folks, so I'll probably see you next week for another installment of practical use of indicators. We'll be taking another indicator next week and taking some trades based on that indicator. Once again, if you have any questions, please feel free to get back. I wish you all the best in your trading. Thank you for being over here. Have a good trading week. Have a great weekend, and I will see you next week. I'm in the room for some time, so if you have any questions, please feel free to let me know. Alright, Susanna, thank you. Thank you for being here. I'll see you folks later. Alright, Forex lady, thank you so much. Thank you for being over here. It's always nice to talk to everybody.